In this video, we'll cover 15 cheap dividend stocks from a variety of industries. All of the equities are at least 10% undervalued in comparison to one-year target projections of professional analysts. Furthermore, all of the stocks have at least 10 consecutive years of dividend increases. Of course, this did not imply that you should rush out and buy or sell something without first conducting your own investigation. We're not specialists, and just because we calculated that something is underpriced doesn't imply it's guaranteed to rise, so don't accept this as a precise investing advice. Hey, welcome to Stock Market Mate. Today we'll talk about August's cheap dividend stocks that you need to consider this 2022. Before we get into it, subscribe to the channel and hit the notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. We'll only share a few relevant facts about these firms, but you should always dive far deeper to understand a company's financial statements, trends, dangers, competitors, and so on before investing. We made this video in mid-August, so prices may have changed since you're watching. Number 1. Verizon Communications Incorporated, or VZ. Verizon is the number one stock in our list. Our one-year fair value target price of VZ is $60, which is approximately 34% higher than where it is today, compared to analysts who have it at $54, which is over 22% higher than where it is today. VZ has a fantastic 5.7% yield, a low payout ratio of 47%, a very low 2.1% 5-year dividend CAGR, and a steady 17 consecutive years of dividend increases. We believe telecoms are currently in an unfavorable state, therefore pessimism is causing prices to fall slightly. People are concerned about Verizon's debt, which is now slightly more than AT&T's debt. VZ's total debt is listed on its website as $157 billion. AT&T's debt is also very enormous, totaling $136 billion. That is a lot of money, but it is a lot less than AT&T was in before the recent WBD spinoff, when they were in debt for $208 billion. Yikes. Number 2. Walgreens Boots Alliance Incorporated, or WBA. The following stock on this list is Walgreens Boots Alliance. Our one-year fair value target price for WBA is $50, which is approximately 27% more than the current price, while analysts have it at $45, which is approximately 14% higher than the current price. WBA is a dividend aristocrat with a 4.92% yield, a 35% payout ratio, and a 5% 5-year dividend CAGR. WBA is a significant amount of debt to be aware of. And another issue we have is that e-commerce pharmacies have harmed them in some way. For example, Amazon has a new online pharmacy that we started using, and it's fantastic. Furthermore, if Amazon begins to create physical pharmacies, and it has been speculated, it will further affect companies like WBA. But people still go to Walgreens for various things, and having same-day doctor services would make them more appealing. Number 3. British American Tobacco plc, or BTI. British American Tobacco is the third stock on the list. Our one-year fair value target price estimate for BTI is $55, which is approximately 39% higher than it is currently compared to analysts who have it at $51, which is around 29% higher than current pricing. BTI offers a very high yield of 7.54%, a payout ratio of 65%, a reasonable 5.6% 5-year dividend CAGR, and 22 straight years of dividend growth. BTI is attempting to evolve by delivering more combustible-free products. As firms like these face numerous headwinds from increasingly health-conscious people to risk restrictions influencing their revenues. They incur some geopolitical risks as a result of the ongoing Russian-Ukraine conflict, but the impact on their total revenue is minimal. Some large funds have recently declined in stocks, so there is another risk to be wary of. We like the income BTI provides, and believe it will be able to do so in the future, but we're not in it for the long-term price appreciation. Also keep in mind that the payout may move up or down owing to the currency conversions. Number 4. Tyson Foods Incorporated, or TSN. Tyson Foods is the next stock in our list. Our one-year fair value target price estimate for TSN is $105 per share, which is approximately 29% more than the current price. Analysts put it at 99.50%, which is around 22% higher than current prices. TSN offers a low 2.1% yield, a very pleasant and low 18% payout ratio, a fantastic 17.2% 5-year dividend CAGR, and a 10-year streak of dividend increases. Tyson owns various traditional meat products, and its grown and rooted brand has a minor foothold in plant-based meats. Number 5. Enterprise Products Partners L.P. or EPD. Okay, the next stock on our list is Enterprise Products Partners in the energy sector, which is a master limited partnership, aka MLP, is an American midstream natural gas and crude oil pipeline firm. MLPs are their own business entity type that you should investigate, much like REITs. The business concept of an MLP is to use the majority of its cash flow to make reasonable dividends to investors. They fund expansion by issuing external debt and stock. Our one-year fair value target price estimate for EPD is $35, which is approximately 35% more than it is currently, compared to analyst estimates of $29.56, which is approximately 14% higher than current pricing. EPD has a great yield of 7.39%. However, unlike REITs, we don't use that payout ratio. They also have a low 5-year distribution CAGR of 2.4% and an incredible 22 consecutive years of distribution rises. Number 6. Exxon Mobil Corp or XOM. Exxon Mobil is the next stock. Guess equities have performed admirably this year. Our one-year fair value target price for Exxon is $115, which is roughly 28% higher than where it is now, while analysts have it at $107, which is about 20% higher. We should note that oil stock prices are heavily influenced by macroeconomic factors such as supply networks, the pandemic, the war in Ukraine, and who knows what else. As a result, we believe the oil will remain hot for some time. However, you never know when gas prices will fall. Regardless, Exxon has been doing well lately. Their balance situation is improving, and we expect the small dividend increases to continue to rise. Number 7. Goldman Sachs Group Incorporated or GS. Goldman Sachs is the next stock on the list. Our one-year fair value goal for Goldman is $450, which is approximately 34% higher than it is today, while analysts have it at $406, which is around 21% higher than it is today. GS has a low 2.39% yield, a great 18% payout ratio, a fantastic 24% 5-year dividend CAGR, and has increased its dividend for 10 years in a row. We believe that the current economic environment will create uncertainty for Goldman and most bank equities, but with risk-income reward. One negative influencing element for Goldman is that mergers and acquisitions are occurring less frequently in the business as a result of the current difficult market. However, because Goldman is the world's greatest investing firm, they usually come out on top in the long run. Examine their price to book in comparison to their competitors for further information. Number 8. JPMorgan Chase & Company or JPM. Our one-year fair value target price for JPM is $155 per share, which is approximately 35% higher than the current price, while analysts put it at $145 per share, which is approximately 26% higher. JPM boasts an excellent 3.46% yield, a nice 32% payout ratio, a great 15% 5-year dividend CAGR, and 10 years of continuous dividend increases, as well as an incredible CEO in Jamie Dimon. Number 9. Bank of Montreal or BMO. Our one-year fair value target price for the Bank of Montreal is $130, which is around 31% higher than the current price, while analysts have it at $137, which is approximately 38% higher. BMO offers an excellent 4.38% yield, a reasonable 34% payout ratio, and a decent 8.4% 5-year dividend CAGR. And what's more, they've been paying dividends since 1829. Number 10. AbbVie Incorporated or ABBV. AbbVie Incorporated or ABBV is the next stock on the list, and it is in the healthcare sector. Our one-year fair value target price for ABBV is $150, which is roughly 9% higher than where it is now, while analysts have it at $162, which is about 17% higher. ABBV is a dividend king with a 4.09% yield, a 42% payout ratio, and a remarkable 17.5% 5-year dividend CAGR. Hopefully, everyone is aware of ABBV's major risks and Humira revenue, which they are attempting to mitigate as much as possible. Of course, there are dangers associated with rules and policy changes. Number 11. Merck & Company Incorporated or MRK. Our one-year fair value target price for MRK is $100, which is approximately 13% higher than where it is now, while analysts have it at $99, which is about 12% higher. Merck has a 3.16% yield, a 35% payout ratio, an 8.5% 5-year dividend CAGR, and 11 years of consecutive dividend increases. Number 12. ABM Industries Incorporated or ABM. ABM provides janitorial services, engineering, parking, custodial, and other services. Our 1-year fair value target price for ABM is $55, which is approximately 23% higher than where it is now, while analysts have it at $56, which is about 25% higher. ABM has a low 1.75% yield, a respectable 22% payout ratio, and a poor 2.8% 5-year dividend CAGR, but they have increased dividends for almost 50 years, making them a king. ABM has been steadily increasing its earnings per share for quite some time. However, we wouldn't classify it as a high-growth firm. We enjoy how it's uninteresting and off the radar. It's a steady stock, but it's cheap right now. Number 13. Pentair plc or PNR. Pentair offers a variety of water solutions, as well as designing, manufacturing, and selling pool equipment. Pentair has recovered well from its pandemic lows, but it still has a number of concerns, including debt and rising prices, which we'll leave to you to investigate. Our 1-year fair value target price for PNR is $55, which is roughly 9% higher than it is now, while analysts have it at $65, which is around 29% higher. PNR offers a modest 1.71% yield and a respectable 23% payout ratio. However, owing to a recent spin-off, we didn't include their 5-year dividend CAGR and number of years of dividend increases. Nonetheless, they are considered an aristocrat. Number 14. Altria Group Incorporated or MO. Our 1-year fair value target price for MO is $55, which is roughly 24% higher than it is now, while analysts have it at $48, which is about 8% higher. MO offers a great high 8.16% yield and a high 77% payout ratio, which is consistent with its management goals. They have an excellent dividend CAGR of 8.1% over the last 5 years. In reality, they should be announcing a dividend increase on August 25th, though we believe it will be less than their typical dividend hikes. Number 15. National Fuel Gas Corporated or NFG. This brings us to the last stock on the list, National Fuel Gas Corporated, a diversified energy firm. Our 1-year fair value target price for NFG is $80, which is approximately 13% higher than where it is presently, while analysts have it at $78, which is about 10% higher. NFG has a low yield of 2.67%, a payout ratio of 33%, a 5-year dividend CAGR of 2.5%, and is a dividend king. With crude oil prices at an 8-year high, National Fuel Gas sold its oil drilling activities in California to focus on its natural gas production operations in Pennsylvania. NFG is a conservative play, so if it appeals to you, begin completing your research and delving into its specifics. Before we end the video, it's vital to recognize that 1-year price forecasts are subject to alter when new information becomes available. It is also important to recognize that there are numerous ways to assess a company. And like with anything else in investing, using a mix of measures, trends, and data points frequently yields more insights than depending on just one. It's critical to recognize that, regardless of a stock's inherent value, the market frequently overpriced or underpriced it. However, in the long run, the market gets it right as stock prices return to the company's true intrinsic worth. This was summed up in Benjamin Graham's famous quote, "In the short run, a market is a voting machine, but in the long run, it's a weighing machine." In the short term, the gravity of intrinsic value may be overshadowed by stronger influences like news headlines, global events, and Reddit warriors. The market frequently overreacts to positive or bad news, which value investors can then take advantage of. What we mean is that consumers frequently buy or sell based on emotion rather than business fundamentals, which is why stock prices can appear to do irrational things in the short term. However, gravity and physics win in the long run, and stock prices tend to trend toward their true fundamental values. Well, that's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!